Hi, I'm Richard Murphy, and I made a video, and we'll link it below this one, which explains that in August 1971, the gold standard, which meant that gold backed up the value of the world's currencies, came to an end. And in its place came the system of the backing for money that we now have, which is quite simply that governments promise to pay. Now, that's an extraordinary thing for us to accept until we understand something which is really important, and that is called the economic multiplier. Now, when a government spends, if you believed a right-wing politician, you would think that there was a great big bottomless bucket into which the money was poured, never to be seen again. Everything, according to them, that a government spends is somehow waste. But that is completely and utterly untrue. Governments do not waste money when they spend. They may be able to sometimes spend it better than they do, and we've all got our own pet hates amongst government spending, me included, I should add. But they don't spend the money and see it utterly disappear without trace, which is what the implication of that narrative is. Instead, when a government spends money, it goes to someone. Now, the simple fact is that the vast majority of people that money goes to will turn out to be real people. Let's look at the UK economy. What are the biggest spends on by government departments? Well, pensions and social security. So that money goes to real people. And healthcare, where over 70% of the costs are with regard to employment. And education, where most of the costs are with regard to teachers, and so on. You can immediately see that, in fact, most of what the government spend simply becomes someone else's earnings, whether that be a pensioner, whether that be a person who's in receipt of benefits, whether that be a person working in the NHS or a teacher or a teaching assistant, whatever it might be, whoever they might be. The fact is that vast amounts of government expenditure simply become people's wages. Now, those people have worked for that income. Let's not pretend otherwise. They've either got it because of an entitlement earned over years of work, pensioners, or because of national insurance contributions paid, which give them an entitlement to benefits received, or because, in the case of the NHS and teachers and people who work for the civil service and so on, well, because they've actually just gone to work for a living. So this is income. Government spending is other people's income. It's the basic rule that we need to remember. The money isn't lost. It goes into the economy. It actually adds to our gross domestic product in very many cases. We record it as national income. But there's something very important about that income, and that is that tax is paid on it. Now, on average in the UK, people pay overall, taking all taxes into account, that is income tax and national insurance and VAT and the contribution that they make by the payments they make to companies towards corporation tax and everything else, add it all up, and on average people pay around 33% of their income in tax. A little bit more in some cases, a little bit less in others, on average 33%. So when the government spends £1, 33p pretty much guaranteed to come back. Only 67p is a cost to the government. 67p also is what ends up in the bank account after taxes of the recipient. Let's call them a teacher. What does that teacher do with that money? Well, if they're like most people, and I'm talking here about averages, and I therefore know this is true, they will spend what they get. Most people in the UK have relatively limited savings. And so if they get an extra pound of income, they spend the net proceeds, the 67p. And the moment they spend that 67p, it becomes somebody else's income. Now, it might go through various stages on the way. It might go to a retailer, for example, and some VAT might be paid. They might buy some goods, which of course will therefore have been bought by the retailer from somebody else. But eventually, that retailer will either pay their own staff, or the person they bought their goods from will pay their staff. The fact is, we don't pay anybody else but people at the end of the day for producing the goods and services that we consume. We don't pay the land. We don't actually pay returns to money, although it might look like that when we pay interest. There's always, at the bottom of the pile, someone who gets the cash. Now, that means whoever that someone is, will, we hope, pay tax. Of course, if the money gets diverted into a tax haven, no tax is paid. The money is lost to the UK economy. That closes the circuit. The money doesn't go round again. If a person saves what they receive, that stops the circuit. The money doesn't go round again. But as long as the money spent by one person goes to another person who spends it, then the 67p is taxed. And how much tax is paid on that? Well, roughly 22p. So after the 67p has had 22p deducted, there's 45p left. That 45p is spent and the next person gets it. And they pay roughly a third in tax, which is 15 pence. And what's left over? Roughly 30 pence. And they spend their net receipt, which is going to be 20p after tax. But that 20p, when it's received by somebody else, will, after tax, now we're coming down into parts of pence, but let's call it, 13 pence, then, it's still going to be paid. Now, what the point I'm making is this: the money keeps going round. So ultimately, when the government spends, there's a very, very good chance that unless it ends up going abroad, either to pay for imports or to get lost in a tax haven, or it gets stuck in a bank account as savings, which means that the circuit of money flowing around the system ends, then the amount spent will give rise to a return to the government of literally the money injected. It will take quite a number of circuits. It may take quite a long time. There will be a lag between the spend and the money coming back. That's inevitable. But the government, by spending, actually generates its own tax revenues. Now, it's an extraordinary thing to get your head around in a sense, but it's also really important because it means that the government's promise to pay is backed up literally by the fact that it knows that when it does pay, it will get money back in the form of tax. The spend comes first, the tax comes second. And what is more, in very many cases, when the government spends, it gets back much more than it spends out. Why is that? Because the economy is boosted by what it spends money on. Now, how does that happen? Well, quite simply because if, for example, the government spends on healthcare, we know that there is a significant boost to productivity in the economy as a consequence. Healthy people work harder. Healthy people simply go to work. Healthy people don't need to be cared for by their relatives, so they can go to work. Healthy people are in a better mood, so they're more productive. And on and on and on. The consequence is that those people do simply go to work and add to the number of people at work, and when they are at work, they do produce more. Therefore, spending on healthcare has an extra boost. It's not just the money comes back from the tax spent in the first place, but there's actually an economic boost to the economy as well, which increases the yield on top of that original return of tax. The benefit of that is that not only does the government know that when it spends, it's going to get a lot of the money back eventually in tax, but it knows it may get more back because it's boosted the economy as well. Now, again, over what period we measure this does have some influence on the amount that we claim the return is. I'm not going to get too worried about the precise timings and the precise returns. What I am saying is the government's promise to pay is not hollow. The government's promise to pay is real. This multiplier effect, injecting money into the economy and boosting activity as a consequence, with the money flowing around as a result, and sometimes much more than just flowing around, but actually increasing the overall flow because of these productivity results, which also are seen in things like education in particular. Because of those consequences, we see net benefits from government spending, which means that that promise to pay that the government makes is really, really strongly backed. This is no hollow promise. This is a real promise because the government can back it up. We didn't need a gold standard. We don't need anything else to back up the value of money. We just need to believe that government can make good decisions. Now, that's a separate issue for us to discuss, and it's the basis on which, of course, democratic debate should take place. And there will be valid disagreements about what is the right thing to spend money on. But what we know is that overall, the levels of spending by governments in the UK have been remarkably consistent, whoever has been in office. And that's because governments know they can afford to spend, because they know they will recover what they have spent, and that they know as a result, the money that they inject into the economy has value, and it has value because people will work for it, will use that money in exchange as a consequence, and will pay their taxes in it. And that cycle gives money its value, and gold is completely irrelevant. Thanks for watching. If you're interested in what I've been saying in this video, please subscribe. There is a button below the viewing screen. If you're interested in what I have to say on Twitter, I'm at Richard J. Murphy on that medium. If you want to look at my blog, that's taxresearch.org.uk, and we have a Facebook page as well, Richard J. Murphy. So one of those things will get you more information on what this video series is about, and I hope I'll see you again soon.